The problem is that decade after decade, as you get to higher and higher public debt to GDP, let's say over 100%, you start to get kind of a wash where if you raise rates, it does slow down bank lending, but also actually increases fiscal deficits, which is another way of pouring money into the economy. And that's where the United States is now, where they're kind of playing, those forces are kind of playing tug of war. And then if you go far enough, then you're through the looking glass, like Japan, where public debt is so high, bank lending is so low that you actually get a positive correlation. You risk having a positive correlation where higher interest rates could actually increase inflation. And the central bank basically loses its tools to combat inflation and becomes almost entirely a fiscal um, lever situation.
Over the past years, we have seen a fundamental change in the macroeconomic environment. After years of low inflation and low interest rates, inflation has come back with a vengeance, reaching double-digit rates in some countries. After some initial hesitation, central banks around the world have responded forcefully to the inflationary threat, leading to a rapid and broadly synchronized tightening of monetary policy across advanced and emerging economies. In the euro area, too, the pace of rate hikes has been unprecedented. This rapid change has caught many by surprise. In December 2021, market participants still expected policy rates to remain in negative territory until the end of 2024, virtually unchanged relative to the end of 2019. The unexpected sharp rise in interest rates has exposed fragilities in the financial system that had built up over the long period of low interest rates, adding to the uncertainty caused by the pandemic and Russia's war of aggression against Ukraine. Macroeconomist and independent financial guru Lyn Alden shares her view on the topic of fiscal dominance and its relationship with inflation. Join us as we now get into the video, and don't forget to like this video, subscribe, and drop your comments below.
So right now we have a period of disinflation. It's in part because energy came off its highs as the supply and demand balance normalized, and also, both in the U.S. and globally, we've had slowing indicators. Some of them point towards recession. Other ones are still kind of in that gray zone where it's above a recession, but it's not exactly booming. And so by slowing down the state of the economy, they've helped to get inflation under control. I think the biggest challenge is that when we look at the history of inflation, there's really two types of inflation. There's bank lending driven inflation, which we know from the 1970s. That's basically when, public debts are pretty low. Most of the money creation is from bank lending. And so the Federal Reserve is primarily designed to try to control that type of inflation. And they can do so by raising rates, reducing rates, and taking other measures to try to influence either more loan creation or less loan creation. The other type of inflation is the type that we see normally around major crises or very high public debt situations like World War I, World War II, and here in the 2020s, which is fiscal-driven inflation. So it's not because of excessive bank lending; it's because of very, very large fiscal deficits that were monetized by the Fed. And I think the biggest challenge that the Fed find themselves now is that they're fighting fiscal-driven inflation with tools that are primarily meant to constrain bank lending. And so the best they can do is kind of slow down bank lending, which wasn't really excessive to begin with, to try to offset some of what happened from the fiscal side, and as well as other things like energy supply chains, things like that. So they're getting inflation under control, but not necessarily the way we'd want, which is disinflationary growth. So in general, when people say they want inflation under control, and if you were to ask and say, well, do you want a recession? They'd say, no, I don't want a recession. So what people really want is they want basically stable money and ongoing economic expansion, basically life getting better on average for most people. Whereas what the Fed's primarily trying to do is slow down the demand side enough to offset some of the inflation that happened. And so the challenge is that if you have very large fiscal driven inflation, and then you constrain the private sector enough that you cause a recession, you get the situation where it's not exactly what people wanted. You might hit your target, but it's kind of a Pyrrhic victory because you hit inflation in a recession. And then the question becomes, when you want to inflate out of that recession, you want to stimulate out of that recession, if you haven't actually addressed the core drivers of inflation, the risk is that they're ready to reemerge as soon as you want to have another period of economic growth or reacceleration. So when you look at things like the Purchasing Managers Index, when you look at various kind of cyclical rate of change measures of economic growth, if inflation is this sticky on a downtrend in those indicators, we have to ask the question, what's going to happen with inflation next time we have another reacceleration, another period of growth? If we haven't addressed those core issues, if we've kind of suppressed other areas enough to kind of get inflation under control, paper over it, then the core issues are ready to reemerge unless we actually address those.
Since the start of the unexpected sharp hiking cycle, we have witnessed repeated episodes of financial distress in different parts of the world. Many of them are in one way or another related to the quickly changing interest rate environment. Historically, global interest rate hiking cycles often coincided with bank or other financial distress. For central banks, this raises the question of what the risk of financial instability implies for their policy choices at a time when inflation and underlying inflation in particular remains stubbornly high, suggesting the need for further policy tightening. Alden further shares her view on energy and its very important factor in the economy, and also she emphasized possible inflation control measures.
Inflation sustainably under 2%, if fiscal deficits are 5, 6, 7, 8, 9% of GDP. It's basically you have to shrink the private sector by a significant amount, or you have to have absolutely massive productivity gains somewhere, so that the growth in the money supply has got a bigger than normal gap between CPI changes, like you see, for example, in the 1990s, like you see, certain periods. The other side is energy security. So right now, Europe has some of the worst inflation problems in the developed world, and it's in large part because their energy side was worse than what the United States went through. They have less energy security. And the ripple effects from that period are still hitting them, even though they've warm winter and other factors have largely stabilized it for now. And so I think the other factor is making, countries can make sure that they have energy security, which is, it is in some ways a fiscal decision, but it's a productive fiscal decision. It's basically saying, okay, what can we do to either get out of the way of energy production or encourage energy production, so that, in the subsequent years, we don't have another spike like that. And one of the risks is that here in the United States, so natural gas, unlike oil, is not very fungible in the sense that transportation costs are a big piece of natural gas, whereas oil is relatively easy to bring around. And so when European gas spiked, and also Japanese gas spiked, we didn't see a similar magnitude in the United States, because you can't just buy U.S. gas and immediately put it over in Europe. There's a limited amount of LNG export capacity. But over the coming years, they're building more and more of that. And so over time, you should, in theory, see a narrowing of that differential, which should be decent for Europe, but then could raise average U.S. natural gas prices, which is obviously good for producers, but not necessarily great for American consumers. And so I think over time, whether or not you're in the United States, whether or not you're in Europe or elsewhere, the various components of the energy supply side are similarly important to getting fiscal stabilized. I think one of the challenges that is, in some ways, the Federal Reserve is almost like the fourth branch of government. It's a semi-political organization, and they have certain mandates, and it can be very politically hard to say we can't hit our mandates right now because there are things outside of our control. If there's a war and oil spikes at $2 a barrel, their inflation target's going to have a problem. If fiscal deficits are running, say, over 10% of GDP, which is not right now, but they were, it's kind of like saying this is just not our tools can't necessarily address that. But because confidence is a large part of the system, the Federal Reserve always essentially tries to say, okay, we're gonna use our tools. And the problem is that their tools are almost entirely designed around either trying to stimulate more bank lending or reducing bank lending. And the problem is, if that's a smaller component of money creation than fiscal deficits, then their overall impact is muted. And then if you get to a severe enough spot, like let's say Japan, for example, they have over 250% debt to GDP, public debt to GDP, and bank lending is very sluggish there. Demographics are declining. There's not a lot of booming credit demand. And so if they raise rates, it would actually dramatically increase the budget deficit at a larger amount than it would affect bank lending. And so they could actually, it could be bad enough that increases in rates could be inflationary unintuitively. So when public debts are low and most money creation is from bank lending, rates do exactly what we think. We think that, okay, as we raise rates, it'll slow down bank lending. That's normally how it works. If you get to a point where public debt is so high, and demographics are sluggish enough, where most of the money creation is from fiscal deficits and public debt's high, then when you increase rates, in addition to not being very effective at slowing down inflation, there's a risk that actually increases inflation. And so the United States is not really there yet, but we're kind of on this point where, because the inflation is mostly fiscal driven and because public debts are pretty high, It's just not a very effective tool, even though the Federal Reserve is not really in a position politically where they can say it's not our problem. They have to kind of take it on as their problem and try to use the tools they have.
When the G20 finance ministers and central bank governors meet in Gandhinagar next week, the world will be looking for joint action to address rising economic fragmentation, slowing growth, and high inflation. Agile multilateral support is vital to tackle common challenges posed by debt vulnerabilities, climate change, and limited concessional financing, especially for countries hit by shocks not of their making. In April, the IMF projected global growth at 2.8% in 2023, down from 3.4% in 2022. The bulk of it, over 70%, is expected to come from the Asia-Pacific region. Yet recent high-frequency indicators paint a mixed picture. Weakness in manufacturing contrasts with resilience in services across the G20 countries and strong labor markets in advanced economies. At the same time, financial fragilities uncovered by tight monetary policy require careful management, particularly as restoring price stability remains a priority. Global headline inflation seems to have peaked and core inflation has eased somewhat, particularly in India. But in most G20 countries, especially advanced economies, inflation remains well above central banks' targets. In the fight against inflation, there are some early signs of monetary policy transmitting to activity, with bank lending standards tightening in the euro area and the United States. That said, policymakers should avoid premature celebrations. Lessons from previous inflationary episodes show that easing policy too early can undo progress on inflation. That's why it is vital to stay the course on monetary policy until inflation is durably brought down to target, while closely monitoring financial sector risks. Here, clear central bank communication and financial sector oversight are needed to reduce the risk of disruptive shifts in financial conditions. Fiscal policy must also play its part. Tightening the purse strings after a period of pandemic-related exceptional support can support disinflation, rebuild buffers, and enhance debt sustainability, while temporary and targeted measures may be needed to help vulnerable people cope with the immediate cost of living crisis. At the same time, consolidation efforts should protect growth-enhancing investments where space allows. Why? Because while prospects are mixed in the near term, the medium-term outlook for the global economy remains bleak. The IMF forecast for global growth over the medium term is around 3%, well below the historical average of 3.8% during 2019. Moreover, economic fragmentation will both undermine growth and make it harder to tackle pressing global challenges, from rising sovereign debt crisis to the existential threat of climate change. How do you think the economy would respond moving forward? Let us know what you think in the comment section below. Always remember to hit the like button, subscribe, and turn on notifications. Thanks for watching.